Hey, everybody. Welcome back to Beer and Money. My name's Alex Collins, and today we're going to be doing the second installment of To Roth or Not to Roth. So today it's all about how do we get money into these various different accounts? What are the different structures and why? So when we're talking about Roth, we're talking about using dollars that are after tax dollars going in, they grow tax deferred, and when we go to pull it out, there's at least ways or mechanisms for us to pull it out income tax free. I say that because each one of these things works a little bit differently. These are relatively complex tax strategies, or can be. Please make sure that you're consulting your tax advisor, like your CPA, or whomever does your taxes for you, before embarking on any of these strategies. So the first strategy, or let's go ahead and walk through all of them. The first is a Roth IRA. The second is a Roth 401k. The third is going to be using a backdoor Roth. The fourth is using municipal bonds. And the fifth is using permanent life insurance. So not all of these are created equal. It depends on your situation as far as which one works best. Let's go ahead and walk through them. So a Roth IRA, first, you can only contribute $7,000 per person per year. If you are age 50 or older in 2025, you can contribute an extra $1,000. These limits do change, so make sure that you're adjusting it for whatever year you're making the contribution. The other thing to note is that there are income limits. If you're in higher income brackets, you can get phased out of the ability to do this. So for individuals, that starts at 150 and goes up to 165. For married filing jointly, it starts at 236 and goes up to 246. If you're in that band, make sure you're working with a CPA to go ahead and calculate it. It becomes very important. You probably don't want to make contributions until you know your exact tax dollars. You have up until tax filing day of the following year. So a 2025 contribution can be made up until tax filing day of 2026, or whenever you file your taxes, whichever is first. So that gives you a little bit of a feel for it. It also talks about the importance of making sure that you run some of these calculations to know whether you're eligible or not. Roth 401k. Roth 401k is built into 401k document. So not everyone's 401k is going to allow for Roth. Most of them, or most of the good plans, especially the big companies these days, it's rare that we come across a plan that doesn't have Roth. If you do, reach out to us and we can go ahead and see what we can do about potentially adding that to your plan. We'd obviously have to do that through whoever the business owner is at your place of employment. But this can be up to any of the employee contributions or the catch-up provisions in your 401k. In addition to that, some plans allow for after-tax contributions, and these can usually then be converted. And so you're putting in after-tax dollars and then converting into Roth. We need to make sure that these provisions exist in the plan prior to doing so, but this can be very helpful and a way to put extra dollars into Roth. The third way, or the second way that that can potentially work inside of a 401k, is through a conversion. So if you have dollars on the traditional side, whether it's employee dollars or employer match, you can potentially convert those dollars from traditional over to Roth. When you do so, you're going to have to pay taxes at the current year. So we need to make sure that we have a plan for how we're paying for the taxes. We need to do a bunch of calculations to figure out whether it makes sense. The earlier you are, the younger you are, the lower your current tax bracket, the more that we expect your income to rise, the better off we are in general. And this can also work with a traditional IRA. So it's called the backdoor Roth, or backdoor Roth IRA, where what we're doing is we're making contributions to a non-deductible traditional IRA and then converting it. We have to be very careful with this. If we have other traditional IRAs, the IRS will aggregate all of them together. And so if you've got $90,000 in a traditional IRA and you try and put $10,000 into a non-deductible IRA and convert it, you're not converting the $10,000 in the non-deductible. Like, we have the same limit, so we can't put that much in a non-deductible. I'm using this for ease of example. Well, what would happen would be $10,000, $10,000 and $90,000. Those would get aggregated together. So we'd have 1/10 of the conversion would be the non-deductible, 9/10 of the conversion would be the traditional IRA, and then we then have to track the basis of the other $9,000 of non-deductible IRA. This becomes a mess and a nightmare. I do not recommend doing that. If you're going to go ahead and go the backdoor Roth, make sure that you don't have a traditional IRA, or you convert the entire amount of the traditional IRA before doing a backdoor. That can be done over a period of time. It doesn't have to be done in 1 year. Again, make sure you're having conversations with your CPA or your tax advisor. Make sure that you're working with somebody who understands Roth and Roth conversions very well before embarking on these strategies. The fourth way of having Roth taxation is municipal bonds. Municipal bonds are federally tax exempt. You might wind up with some state tax or state income tax, depending upon what state you live in and what municipal bond you're buying. Now, the biggest issue that we see with these is municipal bonds don't work exactly like regular bonds. They work somewhat similarly, but most of the time the tax implications have already been built into the rates of return inside of the municipal bonds. We're also needing to make sure that the municipality that we're buying the bond of has a solid rating. Back in the 90s, there were cities and counties down in California that actually wound up going bankrupt, and it was a big deal in the news back in the early 90s, and there was a bunch of folks that lost a bunch of money as a result of some of this. So we need to be careful with what we're doing, and this is typically for the truly high income folks, because most of the tax benefits are already built into rates of return. And so when we talk about risk reward and what rate of return we're getting, if we're in the 10 or the 15 or even the 22% tax bracket, it likely may not make sense because it's already been built in at a much higher tax rate. And so we can actually get a better rate of return by investing in something with similar risk that drives more rate of return, but then winds up being taxable. Again, talk to your tax accountant. All of these things are very specific to the individual. And the last is permanent life insurance. Permanent life insurance has to be an insurance product first. We have to want to own insurance, as it is an insurance product first. The way in which these things work is that there's like 5 or 6 different main types. They build up cash value. That cash value builds up in a non-taxable account, and we can get tax-free access to it. There are ways that this can become taxable depending upon situation and circumstance. So again, make sure that you're working with a licensed professional. Make sure you're talking with your tax advisor ahead of time. These are important things as part of this strategy, but it can be another location where we can go ahead and get access to after-tax contributions, tax-deferred growth, and potentially tax-free distributions from that type of a structure. Again, a lot of it depends on how we're using it and what we're trying to accomplish with it. So those are the main 5 methods. That's how we can go ahead and get dollars into these things. And now it's just a matter of like, okay, what applies to your situation? Highly, highly, highly recommend making sure that you have a team of folks that are working for you. You want to make sure that you've got a tax professional who's looking forward, not just looking backward. You need to make sure that you're working with a financial advisor or financial planner to go ahead and make sure that they understand what you're trying to do with Roth and conversions and municipal bonds and permanent life insurance. All of these things work slightly differently. So it's really important that you understand why for your situation. And it may wind up being a combination of 2 or 3 or 4 of these things to go ahead and accomplish what you're actually trying to do. Thank you very much for listening to another episode of Beer and Money. If you have questions on this, if this raised any questions, you're like, hey, Alex, what about this? Ryan, what about that? Please head on over to beerandmoney.net. Drop us a message that says, hey guys, I want to learn more about X, whatever that is. We'll either reach out to you directly to answer that question, or it might be something we cover in a future podcast episode. As always, make it a great day. Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklow, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7837085.1, expiration date April 2027.